Let's start with ordinary investments. So remember in equity till now, you'll have been learning all about traditional investments, right? So traditional investments all about investments in traditional, like stocks, debentures, debts, funds. These are all traditional investments. If you want to move away from the traditional investments and you want to search for other alternative type of investments, that is called alternative investments. So this topic essentially looks to tackle everything that is not the traditional investments. Example, let's say to extend even gold. Gold, silver, you guys are looking at this gold, silver boom in price, right? So now everyone is now switching some part of the portfolio to gold and silver, right? You have even gold, silver ETFs and UTIs and so on, right? So these are nothing but not what people traditionally invest in, but something away from their portfolio. To an extent, in real estate is a part of my alternative investments, right? So what do you mean by traditional investments? It's your equity, your debt, your other investments, you have subsidy investments, you have strategy investments. So these are traditional and these are alternative, right? Now a big part, almost 6% of your syllabus in the CFA covers the alternative investments portion, all right, which is what we'll be covering over today and trying to wrap that up. Uh, so quickly look at the index. What we're looking to cover is ordinary features. You need to make sure you understand what are the features of ordinary investments, methods, obviously, and very important part of this is the only practical part of this topic. We have to understand how to compute the returns, okay, the percentage returns of the portfolio using ordinary investments. Because here is very different from traditional investments. The way you compute your ROE or your ROC, ROI, it's a different formula. So learn this part of it practical. And we look at other forms of ordinary investments like real estate, infrastructure, digital assets, with Bitcoin becoming a big thing in the recent 2-3 years. The CFA curriculum has now been modified to include even digital assets as a part of our CFA curriculum within the alternative investments topic. Okay. So broadly, why we need to learn this? Because it's picking up in a big way. Everyone looking at portfolio management using alternate investments also as 20 to 30% of the portfolio, right? It helps in risk management. You want to make sure that you're accessing the non-traditional part of the market, right? Performance and returns are very different. There's illiquidity in this market. You need active management. You can't just like how share can buy and keep it and earn money from that. Here you have to make sure you actively manage and monitor it. Like the silver, if you see the price boomed, the again fell down, the again boomed. So you have to make sure that you are reacting to the changes. You need active investment, right? And one of the biggest reasons why we want to invest in alternative is because it has a low correlation with traditional investments, which also means that you get a better diversification, right? Low correlation means if traditional investments go up, this may tend to go down or maybe same, but it will not go in the same direction. So you won't have a situation where investments go down and this will also go down. This will cushion you from the fall. Obviously, it may also make sure that your rise is not too high, your fall is not too low. Okay. So in a way, you are able to achieve diversification. Very important. Obviously, we also get concept of private capital. So what we learned in traditional investments is public capital, public equity, public debt. Here we look at private capital, private equity, private non-listed debt and equity, where you have a possibility of higher returns, but also a greater risk. We also look at real estate, which you know in India, also in Bombay, is booming a lot. Real estate is booming across the world, even international economy like London, Australia, even there the real estate prices are going up. So obviously it becomes a good source of income, not just in the form of rental, but also in the form of price appreciation. Clear? Okay, example, if you invest in, and obviously there's forex gains also. If you are an Indian investor and you invest in US properties, you will get the appreciation, you will get the rental income, plus you will get the gains on the US dollar to the Indian rupee exchange. Yeah. So diversification and inflation protection is important. Okay. And this is one of the key factors why this is an important learning for every CFA student. Look at the LOS. from the curriculum and from the book. It says, learn how to describe the features for the first one. Categories, please understand what are the features of the ordinary investments and what category you invest in, obviously. What are the investment methods that you can do, and obviously the ownership functions. Okay. And keep learning this and contrasting along with traditional, because alternative are very different from traditional investments. Okay. What is the difference? What are key differences between the two? Let's look at the features. When you do alternative investments, right, then mostly understand that the managers who manage the alternative investments, they have a specialization that's very narrow. It's more restricted to alternative investments. They have a narrow specialization. Okay. We already discussed how the correlation is low, and therefore, because the correlation is low, you have a greater benefit of diversification, right? Diversification is higher. Okay. You have one problem with this is you have limited historical risk and return data, like silver. Do you know what the historical risk and return data is? Not much, because it's not a big commodity, not active. Obviously, last one will become more active, but the data is lesser. Okay. There are lesser regulations, there's lesser transparency. You can just go and buy these off the market in gold, silver. You won't find too much regulations as there is for mutual funds and equity shares, right? There are sometimes unique legal and tax consideration. Example, if you invest in them, you will be subject to short-term capital gains, long-term capital gains without an exemption limit. In equity, you have exemption limit. So therefore, the tax consideration is also different. Okay. One of the biggest differences here is you have to pay a higher fees for this, because this is a niche specialization market, and obviously you also end up paying a performance incentive fees, which is not what you pay for a mutual fund. Normally, a mutual fund you will not pay a specific performance fees, but here you will pay a performance fee, incentive fee. You will also pay a high amount of dealing charges and other fees, right? Connect portfolios, and obviously, normally there are certain restrictions because these are alternative investments. They are less liquid. So you can't just buy today and next week sell it. You have to stay invested in the investment in order to really make money. Right? Like, you can't just go and buy gold and then sell it, because the amount of money you spend in only buying and selling will offset the profit. Right? So here the time period is almost a year. Remember, the fees are high, so you want to stay longer so that you don't redeem early, stay longer and recover the fees and the other part of the returns. Clear? Okay, so keep understanding this difference vis-a-vis the difference that you see in the world of traditional investments, right? Quickly, just to have a look at these categories, which we are going to cover over the next 3 to 4 hours. The various category of investments are hedge funds. And this is exactly like mutual funds, but these funds are having high net worth individuals as the customers, and these hedge funds normally have a lock-in period, and they have a very high risk and a very high return compared to traditional mutual funds. Okay, so they're nothing compared to mutual funds. They are high risk, high return, high net worth, higher returns, higher cost compared to the traditional mutual fund. That's what they call alternative. Private capital. Before company goes public, the capital of the company is invested by venture capital funds or private capital. That's called private capital. Okay, it can be in the form of private debt or private equity, equity and debt. Both of these are called private till the time they go into IPO. Once they go into IPO, they become public shares. Clear? So the private part of the holdings before IPO is alternative investment. Again, you know it's high risk, high return. Real estate, you all know the meaning of that. Natural resources, all things are natural, commodities, onions, all the things that are grown, again, land, timberland. In this, you will have everything that's grown on the sand, wheat, bajra, gawar, all those. You can also trade in all these commodities, land and timberland. Okay. Infrastructure, obviously, infrastructure projects are also great investments. You can invest in let's say, Atal Setu project that is being invested. You can buy, you can put money in that, get some returns from that. So you can invest in infrastructure projects that the government is launching, right? The biggest one was the metro project. When it was launched, people invested in the metro project. They bought bonds, they invested money. So that's also a part of the infrastructure where you're earning money in the form of returns and percentage. Okay. Others are very interesting. You know, some people like to invest in art, antique, furniture, automobiles. MS Dhoni, he has 120 bikes, right? Obviously, the bike fan. But there are people who, apart from that, also buy bikes, buy vintage cars, vintage paintings. Michelangelo, they'll buy the painting for $1 million. They'll keep it there. After 2 years, they'll sell for $3 million. These paintings are also a part of our investments. There are many people who buy vintage art by renowned people and they'll keep it there and they'll sell it at later other auction houses. Clear? Apart from that, obviously, patents, trademarks, litigation actions are also a part of your intangible assets. Clear? So I hope this makes sense as to what are the various types of alternative investments which are different from the traditional investments. Here, hedge funds, private, everything private and not public. Public is traditional, private is alternative. Right. So let's continue, guys. So if you want to invest in alternative, you want to invest, what are the ways? Now, obviously, let's say gold, silver. You can go and just go buy gold, silver, right? Go to market, buy 1 kg gold or 1 kg silver, pay 2 lakh rupees and just buy the bar, or you can buy ornaments, you can buy plates, you can do that, right? So you can directly go and make a direct investment. If you feel you want to buy, obviously you have money, but if you want to buy a stake in a private company, like let's say Flipkart, you want to buy a stake in that. You just go, we don't know, buy a stake, you can do directly. Obviously, it depends if you have the money. If you want to do investing with someone else, you can take another buyer, let's buy 50-50. Obviously, funds are important. He is called a co-investor, right? Again, you're investing in the assets indirectly through a fund, but you have the rights of co-investment. Now, you are the co-investor, you may have another co-investor, you may have another multiple co-investors, right? So you make a fund, you can do alongside a fund, or you can do alongside another investor. It's called a co-investor. Obviously, if I want to involve more investors and do it by way of a fund, like a mutual fund, but don't call it mutual fund. A mutual fund is for the traditional investments. A hedge fund is for alternative investments. You can have a pool of fund, everyone can contribute money and makes a return on that. Clear? That's called a fund investment. When you do fund investment, you invest into funds, pool of money, and you can go ahead with that. Clear? So you can do direct, you can do co-investing with one of the people, or you can do fund investing with multiple people. But all in all, these are more of high net worth, high value, high denomination investment. You can't go and invest in 10 countries. You have to invest like proper, probably 50 lakhs, 1 crore amount in these investments. Mostly the fund investing. Okay. So the other methods, obviously, advantage, disadvantages. We are going to contrast how the three methods will obviously work. You should know this by now. Let's say if you want to buy directly gold or silver, right? You don't want to just buy it, keep it, and sell it. You're managing, you're the manager, you're not managing anyone else, right? You're not paying management fees to anyone. So you are paying zero management fees. Full flexibility, right? But obviously you need to know when to sell. That's also important. Like you can't just go and buy when the prices are going up and then say, oh shoot, the price is falling, so let me sell. You can't do that. That's where you end up requiring expertise, right? Another problem is not expertise, you also might not end up diversifying. Let's say everyone will, wow, gold, silver is good, but what if tomorrow it starts falling and the prices of other investments go up? What if silver is falling and copper goes up? What if gold falls, silver goes up? You don't know where to invest, but you cannot invest all your eggs in one basket, right? So therefore, you have to ensure that you are doing enough diversification. When you are doing on your own, this is more difficult because you're not spreading your investment portfolio. If you want to really do it, you need more capital. And as an individual, capital also is a problem, right? Capital, diversification, expertise, all this become advantages here when you have a fund manager, there's diversification, there's capital. You can invest like 50 lakhs. Here you have to invest straight 1 crore, 2 crores. You can invest a smaller amount and still get an exposure. So the disadvantages in a direct investing are completely offset and they become the advantages when you're doing fund investing. Clear? मुझे diversity मिल रहा है. I'm also getting able to invest in various funds. I can spread my assets. I can also be. I don't have to be restricted by the minimum amount. I can just fine. I'll put 50. I'll put 5 lakhs. That's it. Because of fund investment. Clear? Obviously, expertise is needed here, but here you don't need expertise. Why? Because you're not doing the investment. Manager is doing it, right? Obviously, some disadvantage compared to here is basically here you don't pay fees. You have to pay fees, you have to pay performance fees, you have to pay a lot of fees, you have to pay a lot of money, but obviously you're leaving to the experts to do the work, right? Now this frankly comes somewhere between here and here, right? If you don't want to jump to fund and not pay such a huge fee, you'll find, oh, hang on, I'll probably not want to do only in this. I'll only for co-investing where you want some management, lesser fees, you want to be involved, you have the knowledge, and at the same time you want to learn from the other person's experience. So you're trying to reduce the man fees, not as high as this. So not high as this, obviously. Little higher than this. You want to ensure that you are actively managing the portfolio and you can learn and you can develop. So you are involved. Only the fees are not as high as you, but you have to pay some fees. Right? Obviously, disadvantage of this is when you're doing point of view, you're losing some control. Here you have full control, here you have reduced. Okay, obviously it may be subject to adverse selection because you are two people, both of you are probably biased and selecting. So there's a bias that could happen, and obviously here you require more involvement. Here you're sorry, like boss, you're the expert, I'm doing nothing, you do the work. You're zero involved. Here you get some involvement. Here you are fully involved. Clear? So there are its own disadvantages. Obviously, make sure that you are able to deal with it. Let's say you have a very good feel of the Bitcoin market, you're good at it, you know how to study, then fine. Go to take investing. But let's say you don't know what's let's say silver price rally, you don't understand what silver is, you don't know whether it is in production, why it's going up, what's the reason, you don't know all that, then you can leave it to an expert and say, fine, you deal with it, I will simply invest my money. Here. Now, when you do online investment, you sort of make a structure, right? Remember, it's not just a trust investment. You're going to have a structure with a group of people, right? Now, there are certain terms you need to be careful of. When you do a fund or a pool accounting, right? You'll always have, like a LLP, you'll have a limited partnership firm, okay? So, more like a limited liability fund, but it's a limited partnership firm. You have a group of partners. You'll have one person who's a general partner. He run the business, and he's the person, because we are partners have unlimited liability. So this general partner, he's like the managing partner. He'll say, boss, I hold complete accountability. I have unlimited liability. He's a general partner, right? The other partners limited partners. These partners are limited. Means what? They will have recognized investors, but they will be limited liability to the extent of the risk that they're going to take. Okay? They are obviously having instructions, but they're expected to understand what the risk are. They should understand. They know what broadly because they will come with partners, but their liability will not be unlimited like their general partner. Clear? That's why they call limited partner. So obviously you may wonder, I could call unlimited partner, but that makes sense. It's not unlimited, it's general partner having unlimited liability, and the other partners are called limited partners having that limited liability, and they understand what the risk and returns are going to be. Okay? Obviously, a person who doesn't want to take too much risk will probably say, boss, I am better off, please make me a limited partner. I don't want real partnership. I don't want to face the issue of any fraud or insolvency. Yeah. So the GP and LP partnership is governed by the Limited Partnership Act agreement, like the LLP, where they say, boss, take care, this is structure. You have one GP, several LPs, and with that you are formed your firm. Okay. Now, quickly, let's look at, and this is a very important practical question, the various types of fees and returns that you're going to earn in the world of hedge funds and the world of investment. Now, every online investment, this is similar to what mutual funds also do. Every online investment will always give you a AUM fees. which is typically, let's say 1 to 2% of your AUM, assets under management. So if I'm managing assets for 10,000 crores, I'll get 1%, which is almost 100 crores, right? That's a huge amount, but yeah, that's how they work. That is the amount of fees you're charging on the amount of assets that you are managing. 1 to 2. Yeah. Now, obviously, you manage so much, I'm charging flat. I'm not charging you any more, just 1% because I know that this is my fees for managing. You make profits, it's yours. You make loss, it's yours. I am simply charging you a fee. Now, apart from this, to make me incentivized to do good for you, to make you get better, I'll say, boss, let me do one thing. I will give you, as a manager, I'll say, boss, I'll give you 30% return. You may decide to give me incentive in case I give you more than 30%. So let's say I say 30% what I'll give you. Good. But actually I give you 40%, 42%. So that means I gave you 12% more. So this 12% say, boss, wow, you gave me 42 instead of 30. I'm happy. The extra 12%, let's do one thing. Let's share it 50-50. As a boss, you take 60%. That's mine. But I'm more than happy. I'm incentivizing you to earn more for me so you can share the pot with me. Obviously, you didn't give 12%, I'm not giving you 6, but I'm glad you gave me 12, so I'm going to give you 6% back. That is called incentive because you earn more returns than what was wanted. Yeah? Now, obviously, I want to earn a certain higher returns, which is incentive. I also want to make sure that I earn a certain minimum return. And that is called hurdle rate. Hurdle rate is a rate that if you cross, then I will give you a certain amount of return. Hurdle rate, like, okay, this is a hurdle. Beat it and I'll give you more money. Right? So hurdle minimum return that they expect that they should exceed to earn. So if you want to earn this, please go above the hurdle rate. If you want to earn performance, please give me more than hurdle rate. If the hurdle rate is a certain amount, then I'll give you like this case 30 है 40 is दिया तो 12 के ऊपर 40 30 is the hurdle rate, you want 42, so anything above 30, that's 12%, can be divided among all the people. Clear? Obviously you have soft hurdle and hard hurdle. Soft hurdle means the fees are calculated and paid on the entire gross annual return. If you exceed the hurdle, I'll give you on the entire amount. In a hard hurdle, fees is paid on the annual returns net of the hurdle rate. So I'll probably remove a hurdle rate and then give you the fees on the net amount. Yeah. So obviously soft is better. Okay. Now we know the terms. Hurdle rate. If you cross that, you'll earn the performance fees, and obviously you're already charging AUM management fees. Now, some other terms, very important terms, please read this carefully. This gets tested in sums as well. Okay. Now, what's a catch-up clause? Okay, catch-up. If a GP owns 25%, a catch-up clause allows the GP to receive 100% of the distributions above the hurdle rate until he receives 20% profit generated, and then every excess dollar is split 80-20 between the GPs and the LP. Right? So basically catch-up clause means if I'm giving you 20% performance fee, right? Then that means catch-up clause says that okay, 20% data, but when you are earning more than 20%, right? The excess amount will be shared by you and me around 80-20. Obviously, you take 80, I'll take 20%. So I'm trying to say that I will pay him everything in excess of the hurdle rate. Okay, it's a hurdle rate concept, catch-up clause. I'm trying to catch up till the hurdle rate. Okay? Waterfall. Wait, we'll come to later. High watermark. High watermark means watermark is the highest amount that the fund has achieved. High watermark. Well, let's set the watermark. Today achieved 10, 12, 15. So 15 is the high watermark. 15 से वापस 11 पे आया. So 15 is my high watermark because that is what you achieved. That's what you achieved in terms of the highest point in the course of the year. Obviously, I look at the watermark to decide how much you've given me. Clawback, very easy. Clawback is simple, right? If I paid your bonus, I should be allowed to claw it back from you if you violate some conditions. It's the rights to reclaim part of the fees. Clear? Now, clawback obviously is the important portion to make sure that people do not leave and run away from the company within a year. Okay, so that's clawback. Now, what is waterfall? So, catcher we know, watermark, clawback you know, right? What is waterfall? Waterfall is when, so basically you're making a method of distribution, when you're distributing the method by in a certain order in which allocation are made to LPs and GPs, right? So basically, a waterfall mechanism is where the distributions are in a certain waterfall, right? It goes to this person, then this person, then so the distributions are top to bottom, like how the water is falling, right? So that's why divided by waterfall mechanism is a mechanism to distribute the amounts, right? To whom? To the LPs and the GPs. Clear? So an additional method is called a waterfall mechanism. Is that a bit clear? Obviously, there's a theory around the features, structures. Okay. So let's look at the quiz questions, guys. Take a minute, everyone, and tell me what are your answers. So what do you do? Let's do exam style. Look at these questions. Take a minute to mark down the answers for 1, 2, 3, 4, and then we deal with it. Start. So obviously, make sure that you have understood what we discussed so far in the first part. So let's start. Compared to ordinary investments, traditional investments tend to be less liquid, lower fees, or more knowledge. What's the right answer? What do you mark, guys? It's the other way around. So are traditional investments less liquid? No, they are more liquid, right? You can sell easily. Real estate is less liquid, right? Are traditional require more special knowledge? No. These investments require more special knowledge. Are they lesser fees? Yes. Ordinary investments charge a higher fees, traditional charge a lower fees, right? So the answer is B. An investor who wants to gain exposure to ordinary investments but does not have the expertise to perform, they should engage in what? If he wants to gain exposure to ordinary but does not have the knowledge, he should not do direct. What should he do? Co or fund. Now co also he's involved, so don't do that because he has no knowledge. So let him go for fund because he does not have expertise. If he has the expertise, let him go for direct or co. Both will help. But if he has no knowledge, only fund investing is the right answer. Here, management fees for private capital are determined based on what? It is assets under management, right? Which is normally not just the invested capital, it can be both, but it's more on the committed capital. Yeah, actually, so when we say AUM, actually this term which I use is more for mutual funds, right? AUM. Okay, that's why this term is there, but this term is for mutual funds. The synonymous term for hedge funds and audit investments, the synonymous term is called the amount of not committed capital amount, but the committed capital that you're going to invest in the assets. So here is the capital that you have committed to pay me because I trust your word, right? So this is the committed capital. This is invested capital, this is committed capital. Here, any questions? Now, fourth one. For an investor in a private equity fund, the least advantage of the following partnership terms is, okay, what's the answer? Private equity fund, what is least? So you think in exam, you think of most advantages. Don't even think of least advantage. You'll get it wrong. In the exam, think what is more advantages, right? For a private equity fund. Clawback. Is it advantageous? It's not because it's not helpful, right? For a private equity fund. The least advantages. Okay? Okay, no, sir. The least advantage. So, clawback is actually where you are clawing back the bonus amount. So, therefore, it is good. This is protecting you. Therefore, this is an advantage. So, it's not the right answer. This is the correct thing. Therefore, it's the wrong answer. Okay? For which is not advantageous. European style waterfall, American style waterfall. What is European style and American style? Now, European style is where it is at the end of the period, and this is emitting can be at any time in the year, right? Now, what is advantages? To have a waterfall only at the end or to have it at any point in time? The correct answer is to have it at any point in time. This is more advantage American style because this is at any time you want to do it. And therefore, this is the wrong answer. This is pretty much useless and therefore it is the right answer. It is least advantage. No, sorry, no. European style. No, okay. European style is any point in time. American style waterfall. Of the following limited partnership terms, right? And just notice here they said and, right? So don't just fall for you give me a clawback and European and American, right? Broadly. So you're in practically fun if you look at least advantages, okay? European style, American style. I think American style waterfall provision is more, it's more specific. At least terms are not in use in the earlier ones that we discussed. Right. So American style, as I mentioned, is more of when you do a deal by deal basis, when you're trying to recover the amounts for every deal, you're trying to get the amounts. European style is we're trying to do it on the entire funds. Okay. So normally this is a little better. Clawback obviously is important. European is better because you can get the amount of clawback on the entire amounts. The distribution will be based on the entire funds. So European would be more helpful. Let us please see the explanations also. So traditional obviously requires low fees, low knowledge, less specialized, and therefore it is also more liquid. Okay. We discussed due diligence, review, SINCO. Private capital we discussed it is based on committed capital is similar to assets under management for a hedge fund. And to the difference. And in 4, read this American style waterfall. We have a deal by deal calculation of the incentive fees to the GP. Okay. So incentive fees are paid, followed by the sale of holding and losses, then can result in incentive fees greater than those calculated. So you might end up paying more incentive fees under a deal by deal structure compared to a European style, right? Where you're recovering fees, where in the European style, we are recovering fees based on a whole of fund, right? So it is more advantageous to recover fees using whole of fund, which is European style, rather than recovering fees or paying back and then recovering on a fund deal by deal basis. So American style is good for the person managing. He's making more money, but the investor is affected. So if you have a clawback provision and you have American style, you're going to have the same overall performance fees as a European style waterfall. Okay, European style is much more beneficial to the investor. So therefore the answer is American style is basically least advantageous to the scenario. Clear? American style is least advantageous. Right. Okay, so let's continue. Let's find out more about what the performance of the investments and the returns that you're going to make. Okay, so before you go down, let's quickly look at the risk features and characteristics. Okay. Now, typically, we already discussed all of this exposure high risk, high unleveraged, higher risk compared to traditional investments. There is uncertain timing, obviously. Some of the reasons why alternate investments are more risky because there's a risk that is very high. The cash flows could be uncertain, right? There could be a lot of valuation charge. Now, what will happen is in an alternate investment, you don't have observable market price. Sorry, not there. So therefore, what do? You have to ensure that you value it using the right models, like a Black-Scholes model or a Bachelor model, or a real estate, you look at the InvIT model and so on. You have to value it, look at the model. And therefore, it is more risky. So not like how you can just go and value shares. You go Reliance shares. You know the value in the market that's available for you. But here, the value is not available. Here, obviously, complex fees, you have a high fees, high taxes, high rates, high returns, high performance fees, hurdle rate. All of that makes it very complex. Yeah, returns are not risk adjusted because only this type of investment has a high risk. High risk should have a high return, obviously, but that's not being factored. Okay, and that's why you feel looking low return, but actually a very low risk adjusted return. Evaluate returns while accounting for risk can be misleading. Okay. If you try to account for the returns, let's say in equities I made 20%, and in alternative investments I made 25%. This is pretty much useless. You can't make 25 in this. You should make at least 45% because this risk is much greater than this risk. If you need 20% here, show me at least 40% here, then it's worth it. Because equity is not so risky, but this is risky. And after being risky, if you make 5% more, then that's pretty much useless. That's what we were saying. You have to look at risk adjusted return. The risk adjusted return from this should have been at least 35 to 40%. And then you compare what you earn to what you should have actually earned. So risk adjusted return is more important. Okay. Returns should be highly adjusted for risk, but that's never the case. Okay. So that's the risk features. Obviously, remember when you're doing this, you have three phases of capital cash flows. One is when the capital is committed. You will say, boss, I'm committing $10 million. You committed. Now you don't charge you based on committed capital. After you commit, you are going to deploy the capital. You say, fine, here's my money. You pay the money, deploy, and the money is then deployed, right, to the various companies or projects, right? Once you deploy it, you will start generating income. And that income will basically start rising and being distributed. So you have first stage is commitment where no cash has flown. Then you'll put the cash, you'll put the cash outflows when needed. You'll deploy the money in the projects which are worth investing, and then you'll sit and watch them grow. Clear? So that's how the timing works. So that's some important, interesting concepts. Right now, what is J curve? Okay, so hyper is basically, if you see, it's nothing but the way the curve looks like. Okay. Now you'll wonder where's the J, right? So the J is here. It's like this and like this. That's the J. Okay. Is that clear? So that's the indication of why it's called the J curve. Just by looking at J. Now, what is fun of J curve? Nothing but the fact that if I'm looking at a 10-year period, in the initial period, I'll always start the loss, 10, 20%, and then I'll start recovering. And after the initial 3-4 years, I'll start making profit. And then the profit will keep increasing. Like Swiggy, Zomato, when you invest, the initial investors probably faced the loss. Then it picked up, then it consolidated, then it went up, boom, 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 and then it went to IPO, the people made money. So every such investor will always have the initial loss and then the pickup, break even, profit, and this is called the J curve. Yeah? Okay. Returns improve in the deployment stage, and obviously they occur more in the capital distribution phase. Here, IRR, internal rate of return, is the rate of return that you're earning basically on your investment. Now, this IRR formula, don't worry, as a CFA student, you have a CFA calculator. On that, you put the magic button, tuck, 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 you get the answer, right? This is nothing but the return that accounts for the timing and magnitude. It's weighted by money, right? So how do you find IRR? Just look at the cash flows, put the frequency, and then compute IRR. That's all. It gives you the rate of return. Here, we learn this in bonds. Okay, and we'll also take it up when we reach bonds later. But this is IRR, right? What is money multiple? It's nothing but the amount that you have earned as a percentage of invested capital. It's also called return on invested capital, return on investment. How much have you returned and what's the value upon the total investment, right? So this is basically an accounting formula which tells you what's your percentage rate of return. Yeah. So please learn the J curve effect. Answer what the J curve is. For every startup, you have first a loss and a profit scenario. Now, we had picked this up when we did, if you remember, corporate finance, also equity. What is leverage? Leverage is basically where I'm using borrowed funds. I'm borrowing money. I'm not investing my own money. Let's say I have to invest 100 million. I will probably invest only 60 million and 40 million I'll borrow from someone and pay him interest. that interest I pay him will be lesser than the amount of return I'm making, and that is going to give me leverage return. Clear? So leverage is where my returns are amplified and my losses are also amplified. So if I'm making a return on equity or return on investment, sorry, is 20%, the leverage return will probably be 45%. Because investment includes full investment, but my leverage return is nothing but my return on equity, and equity may be less than investment, but the return is the same. So you're going to double your investment. Yeah. So the amount of leverage return is obviously higher than the amount of normal return, but the same is for leverage loss as well. So be careful. Don't go for leverage if you're not sure of the returns, right? So the problem is you may have to end up having margin for that you took borrowed money, and borrowing money will end up having to pay off, and you might be forced to liquidate, and obviously since the borrowing money, you may not be able to borrow money in the future. So if you borrow money, what's the return you're making? You're making total return on the amount of borrowed khud ka minus you are paying in amount on the borrowed money. So you're earning on the total amount and you're paying interest on the borrowed amount. Obviously, what you're earning is more than what you're paying, your total return will be greater, right? And without leverage, very simple maths, you just have to take how much you invested. With no leverage, you invested full 100 and you earn a certain percentage. Yeah. So learn the formula for leverage return, where it is return upon into total value minus return of the borrowing value upon original value. And here it only return to total value because total value is equal to invested value. Clear the formulas? Okay, that's called leverage return. Any questions on that? Want a quick example on this? Let's say, let's do without leverage. Let's say I made a return of, let's say 20%, and the value I invested is 100 million. So obviously without leverage. So therefore the formula is simple, R into 100 million, right? So what's the return I made? It is 20% times 100, which is 20 million. That's your answer. That's how simple is it. But now come to leverage return. This becomes tricky. Now let's say leverage return, same in formula, same thing, right? Okay, but here I invested from my pocket 60 million and I borrowed 40 million. Clear? 40 million. And this together gave me 20%. Okay. But don't forget that what I borrowed, I'm paying an interest of, let's say 12%. Okay, so let's say 10%. So you understand that 10% come there now, B circle comes obviously leverage return higher. So let's apply the formula now. What is 20% of 100 million? So it is $20 million minus. You are paying 10% on borrowed funds, which is 40. So 4 million. Correct? On what is the amount you have invested? 60. That's the answer. You notice that you made 20 million, you have to pay 4 million, and the investment value is 60 million. So what's the total amount going to 16 upon 60? If you look at 0.60, that comes to almost 26.7. Now remember your return is 20%. How come the final thing 26.7? Please do the math, you can understand what I mean. If you got 16 million on 60, then you have 26.7. But earlier your answer came to 20%. So 20 is less than 20.7. This is a greater number. And why is it greater? Because of leverage. Because you leverage. So have we clear the leverage formula? Here, you made a return, you paid a cost. The net amount is going to be higher from 20 to 25%. Any questions? Take a quick note of that. Clear the formula? Okay. Now, obviously, there are capital restrictions that are imposed by the government. Okay. You have to make sure you take care of those. Okay. Now, you cannot, like this one, except Bitcoin. Separate with Bitcoin, you can't invest freely. You have RBI restriction in India. So, same way, you have capital restrictions, right? If so, they're illiquid, they're not as liquid. There is no transparency, right? Who knows how many Bitcoin being bought and sold? There's no liquidity, there's no or transmitted in the markets. Obviously, people they report at fair value, but very often fair value is not available. Market price will be not available, right? You never know how to value it at. Okay. Now let's come to the three levels of valuation. This is under IFRS 9, right? And also India is also 9 and so on, where you have to value something. There are three levels. One level is where the value is easily available from the market, take the value and take like shares. Share का price is 750 given to you. Active market है, it's quoted. That is called level one. You don't have to worry, don't apply your brains. Just simply take the market price and value it. Second, they're not listed. How do you value them? Example, Flipkart. Listed name. क्या करोगे? Then you have no quoted price, so you have to get observable inputs. Observe the inputs that are going to the valuation. Observe them, find the inputs, put the values, and try to arrive at a certain amount based on the pricing model. Okay, that is where there's no active market. You have to look at observable inputs. Agar inputs are not observable, then what do? Then no choice. Build up some matching model. Look at the model because you will have unobservable inputs. Look at the model, try to build it up, and use your own expertise and knowledge to determine the value. Okay, you don't have any observe, you don't have any market price, any market precedent, anything to look at it. So you have to pick up based on what you think is the best price possible. Clear? So level 3, remember, because liquid, it can give valuation your cost for a long period, but therefore it may not give the true potential. Okay, so level 3 is the most dangerous and also most difficult one to value, and therefore it requires the most amount of judgment. Okay, now we already discussed this, the fee structure. We discussed how you're paid performance fees using a hurdle rate ke upar gaya, then you pay fees. Then based on the high water mark, you'll see the high water mark and decide how much to make the person, how much payment to make the person, so on. So, okay, these are all normally negotiable and they vary from time to time, right? So let's really look at some concepts out of returns which are made before and after, right? So leverage funds, obviously, if you're leveraging your investments, be careful. You may be forced to exit before the real return is determined. So the price may fall, therefore you start investing, you start exiting, and you have profit. That's called leverage funds. Okay. Now remember, there's no problem with exiting, but if you are exiting at an unfavorable time, that's the problem. Clear? So leverage funds are always difficult, and you also know that you'll end up having negative initially, the J coefficient. So why bother leverage? Try to stick through the negative and then you'll enjoy the positive. But in leverage funds, when you go negative, you're thrown out of the market, you can't enjoy the positive. Okay, obviously they also restrict withdrawals. Common liquidity controls, if you want to control, right? Because liquidity, what is the thing? They'll not allow you to sell in a certain lockup period. They'll tell you, boss, ठीक है, बेचना तो बेचो, but हमको notice भी दो, because we want to make sure we're prepared for it. So they'll make you not sell in lockup, also give notice period, redemption fees, and obviously the gates. The temporary limits of total redemptions. Okay, so I'm trying to make sure that you can redeem, but you have a certain time period, a certain amount, you can redeem in that period, in that amount, you cannot exceed the limits. Is that clear? So it's only to make sure that the hedge fund, the fund is not affected by outflow of cash. But remember, every month's cash is much greater. Clear? Fee structure negotiation, when you're doing the fee structure, remember example this one. 220, what's 220? So 220 essentially means I'll charge you 2% on your commodity capital plus 20% on the amount that you excess of the hurdle rate. That's the way they quote it, 220. Yeah. Trade also normally existing formula shares and so on. So this will compute the amount of returns that you're making. Okay. Now obviously there are some biases when you compute returns because I want to show the best returns. So I may try and show you a different picture, which is called as biases. Okay. Example, let's say life cycle problem. Okay, because some investors have unique structure strategies. So if there are different stages of the life cycle, you know, a life cycle looks like this, right? A life cycle looks like this. So depending on which state, where you're still not done much. If you're growing, your growth is very good. You've matured, you stopped your growth. Your growth is good, you're going to stop. So you're going to stop because you'll probably be sure to be declining, right? So growth should also be consistent, right? And that growth comes to the different stages: early, mature, or exit phase. So it depends on how far you want to go and are you able to do that. Okay. So the index normally will not represent a specific asset class. Yeah. Now, what is survivorship bias? Survivorship bias means you will basically try to exclude those that are not done well. Like, boss, this is my funds. These are the ones that have done well. You remove the ones that not done well and say, boss, this is how much I made. But you forgot to, or rather, you purposely removed the ones that did not survive from your returns. And that is misleading. I should tell you returns for everything. But I artificially inflated my returns by showing the returns only for the ones that survived. Clear? Okay, whether I rate is very high. Okay, then backfill bias. What is backfill bias? They may choose to report only one successful funds. Right? They may try to fill the data backwards and say, fine, this is what is this depicted. So fund will be choose to report only successful and they remove the ones that were not doing too well. Okay, they will go and fill it back. Poor, failing, performing, or fail are not reported. Yeah. So this is the backfill bias. Any questions? Now let's come to the most important part, the most interesting part is the return calculation. Now, if you want to calculate return, normally you know the formula is returns, how much you made upon how much you invested into 100, right? So now here there are two formulas. One is after fee return, before fee. What are after fee return? Simple. I need to earn my return after paying my management fees and performance fees. So I'll say, boss, I made 30%. What was the point? I'm also paying you management fees. I'm paying performance fees. I'm paying this fee, that fee. So basically in my hand, nothing much to me, right? So if I want to find out what is my returns after these fees, that is called as after fee return. So all this say fine, you made the return, okay, very good. What are the total fees that you have to pay? You have to consider as a cost. Okay, and therefore the total appreciation minus the fees is your net of return that you paid. Okay, after fee return. Total fee obviously is based on the amount that you earned in excess. Okay, management fees and so on. So this is very important to find out how much is the return you're making. You can sometimes use hurdle rates. What you can say, boss, any return above the watermark, any return above the hurdle rate. You can try to use that to find out what is the competition. Clear? So this is for the after this fees. What are the returns I'm going to earn? Yeah. This is based on the entire concept of features, the computation, the hurdle rate, how do you present the total returns and percentage formula. Okay, so start guys, another take 3 minutes and solve these sums. Right, so the answer, let's start. Returns to investors in already investments are likely to be made in which phase of it? Okay, when will you make, when will it be positive? So remember with the phase I told you. So initially, when you commit, you are not making, when you're deploying, you're not making much. It is mostly when you start distributing because you are positive. So distribution phase will always be where the returns are positive. Yeah. Okay, let's look at the sum. This is quite interesting. What answer you guys got for the sum? Anyone here? Hedge fund. They are saying what's the return after fees? What's the return after fees on the hedge fund? So everyone knows that I earned 30%, right? What's the return you made after fees? So if I made 30%, right? I made 30% return. So the fund has a 1.5% on the end of your fund value and a 50% incentive. So basically, let's say on 100 million, I made 30%. So how much I made? 130. There say I have to pay 1.5% end of your fund value. So 1.5% on the end of your fund and 15% incentive with a 8% hurdle rate on the gains net of the fees, right? So let's see one by one. What is 1.5% of 130? Do that quickly, guys. 1.5% of 130. Kitna aega? 130, 1.5 is 1.3 and 1.95. So you are paying 1.95% at the year end. And you're paying 50% incentive fee with an 8% hurdle rate. Correct? Now you make 30%. Okay. But you're saying anything above 8%, I will pay 15% incentive. Correct? Now don't forget, 30% may say 1.95% is paid towards commission. So how much is left? 28.05. And my hard hurdle rate is 8%. So that means I need only 20.05% on which I will be paying incentive fees. Correct? Into 15%. Right? How that comes to? So I am paying around 3% incentive fees plus 1.95% cost. So how much effectively am I paying? Almost 5%, right? 5% is my total incentive fees. That means my return from 30, if I removed 1.95 and I remove 2.05, I will get 25%. So the answer is C. Here, all I have to do is compute what is the amount 1.5% on the year end. So you can't take 1.5, which is year end. And then you remove the hard of the rate and you go total. Clear? Okay. Last sum. Now read this carefully. I have a primary fund which says 2 and 20, which means 2% is my performance fees, and I will be taking away 20% of every amount after the fees have been hit the trigger, right? Performance fee is independent. It's independent, but this is dependent. The fund will sell a holding for 9% profit. Hurdle rate is 8%. So incentive fee 1% come million, right? Now remember, I'm saying I'll pay 2% performance fee, right? And if you exceed 8%, I'll pay you 20% of that as well. So that means effectively, right? I'm paying you 1% come, 20% is 0.2. Correct? Effectively, right? But that's in softer hard hurdle. I'll end up paying 0.2 or 0.2. Now, what will happen catch up provision is where I'm paying 2 and 20, and I'm also saying that for a profit 9%, hurdle is 8%, right? So that means I'm getting only 8% potentially the amount of fees, and if I allow a catch-up provision, I will be getting extra 1% as well. So only in a catch-up provision, I'll get 1% incentive. That's the difference between the hurdle rate and the fund rate. Yep. Any questions, guys, so far? Any doubts? Please raise your hands. Okay, quickly look at the answers. So they mentioned how you use hard hurdle, soft hurdle. The answers are a little different. Okay, the answers are given here. Your in gross value. So there are many ways to do it. You can make sure you do the straightforward, simple way. Okay. Any doubts? Right. So when you solve these sum, please ensure you understand the way to solve it step by step. Take the total value, remove the man fees, remove portfolio fees, find the gross return, net return, remove the returns amount, and see the question: are they asking for return percentage net or gross? And based on that, you can compute the sum. So please ensure you understand how to use the sum, and you'll notice that the answer came 24.25, but the option was 25%, not 25.1 or 25.04. So that's okay. That's not a big deal because they'll always round it off, right? But look out for rounding of formula, look at the pattern and make sure that you're comfortable. Yep. Okay. So that's the first two parts of this. On that, we'll get a quick break and we'll come back to do the next two parts. Essentially, what you already know, public equity, capital, and debt. We look at private capital, which comprises equity and debt. So that's okay. As discussed, now let's go to the next part of the topic, investment in private capital. Okay. So like I said, all of you know about investments, public capital, okay, public equity, public debt, you've done that correction. Now let's look at some typical parts of investment, private capital and private debt. Okay. Now, obviously, make sure you understand the key features and the characteristics of this and how they work together to diversify. Okay. Now, what is private equity essentially? Private equity looks at essentially the equity in a company that is not yet publicly listed. Okay. So you're investing in companies which are privately held, which are not yet IPO, right? And obviously, it's a different game changer. It's not as easy as investing in listed companies because there you have marketable share, you have a market price, and you can know the price. But in this case, you'll never know what the price is because these are unlisted. So you have to follow a certain valuation model and so on. Okay. With a change in the business conditions, obviously, the focus might change. The risk and returns that they're exposed to will be much more different. Now, when you invest in private equity, okay, the strategy are very different. Normally, it can be you invest through a leverage buyout where you're probably buying out the amount, but you're using debt. Leverage means debt, right? So leverage buyout means use of debt to acquire any private company. Okay, obviously public also you can do a buyout, it's called, but normally it's used for private companies, they're using debt, leverage buyout. Venture capital, obviously people who invest, venture capital fund investors, VC, because the VC investors, they invest in private companies, but they look for high growth. Okay. Development potential means we're investing in companies that are into development, relatively mature companies into the development activities. And distress investing. Distress investing is very interesting where you are investing in a company that is facing a financial distress, right? So because of distress level, you're trying to make sure that you can reap the benefits and try to invest money, make the company grow. So you get a cheap price, make it grow, and then you can sell at a higher price. So that's called distress investing. So there are various types of strategies for private equity investment purposes. Clear? Now, what I've already explained to you, the brief meaning, definition categories. So what is LBO? Where you are trying to purchase using debt. Okay. Now within LBO, right, leverage buyout, there are certain other sub conditions, subcategories. Okay. Now going private, basically where you are buying a company, maybe you bought it and then later you have paid all the shareholders and you have made it private. So you're converting public into a private company is called LBO, public company going private, right? You're buying all the public shareholders. Now, like in LBO, what is an MBO? MBO. Now, L is leverage, M is management. If a management buyout is where the management of the company itself buys out the company from the existing shareholders. So this happens when manager says, boss, I think they're not so interested. We know the company better, they're running a show. And the potential investors or shareholders are not bothered or not so expert, don't have expertise knowledge. So then they say, fine, let's buy it out from them. They acquire the company from the existing shareholders. This is called management buyout. Clear? Now management buy-in. Okay, buy-in for buy-in is where you buy the company and you replace the management. You say, boss, tuno hato, we want a new management. So you're replacing the current management by new management. That's called management buy-in. Here? Okay. So please learn the differences carefully between LBO, MBO, and MBI. Okay. Obviously, the more debt you use, the higher your returns are likely to be. Okay. That magnifies the returns. Mezzanine financing is where you're providing financing to help the company go public. So you know the mezzanine basically means something between two levels, right? So somewhere you have a first floor, you have ground floor, and you have mezzanine floor. Correct? Mezzanine is the bridge gap between the two floors. So same way, your mezzanine financing refers to a bridge gap financing from a private company to the public company. The funding you need to give the company to go from private to public, to grow from ground floor to first floor, right? The beach ka jo gap hai, that's called mezzanine financing, right? The mezzanine floors. Clear? Okay. Now, obviously, if you want to go for a leverage bar, means you're buying debt, you're buying a company by using debt. Obviously, you won't do it without having any certain amount of confirmatory guarantee. Confidence होना चाहिए कि भाई company will do well, right? So you have to ensure that if you are looking for LBO, you need it to be very attractive. You want the stock to be quite undervalued. You want the stock to be depressed. You want the value of the stock to be much more. ये नहीं कि market price बहुत ज़्यादा है. The IV should be much greater than market price. Therefore, there's a potential. You want the people to be willing to work with you. Okay, inefficient companies, where the company is also efficient, you can improve the efficiencies, you will buy those companies. Company having good cash flow, right? Because don't forget, you have to fund the interest, you have to fund the loan. So if you're going to fund them, you better fund them through the cash flows, right? Don't forget, if you're doing leverage or taking leverage, you don't want a company already having leverage. You want a company that already has a low level of leverage, right? Because ऊपर से और leverage लेगा तो तुझे problem होगा. So go for company having a low level of existing leverage, correct? And obviously significant amount of fiscal asset, because you want a company, you want a leverage, you want some collateral. So the company that you're going to buy should have a high amount of fiscal assets so that you can set up a collateral for the purpose of your debt, correct? अगर तुझे लोन लेना ही है तो collateral के लिए assets will be quite helpful. So these are very important reasons or type of companies that are attractive for the purpose of a leveraged buyout. Clear? Okay, this is very important. Some of the way straightforward and understandable, but that is how a leveraged buyout would happen. Okay, now I only explain the terms to you. This is in more detail. Venture capital is where you have like a Shark Tank or where the tigers, they buy the company, they'll buy a portfolio company, and eventually it'll be a part of the fund, right? The VCs are the people who will fund the company and take care of it till it go to IPO. In the IPO stage, they will sell their stake, correct? So they take it from inception to IPO, right? Obviously, these VC investors are involved in the company, they enter the very high risk, and therefore they'll also expect a very high return. The earlier they enter, the more return they'll expect, right? Because the earlier they enter, the more is the risk and the more is the danger. So they will expect an higher risk if they enter at an earlier stage. The later they enter, maybe it's already set up, it's doing well, so the risk is reducing, right? So that's what they normally do. Now, don't forget, venture capitalists generally are active because they want to make sure the company eventually goes into IPO. So they're actively involved, they're looking at data, they get involved, and they'll obviously look at getting equity, because that equity is what they will be working towards, and they want to convert it into IPO shares. Yeah. So this is how the venture capital will normally be working. Okay. Now, mezzanine financing is also called as bridge financing, where they are bridge capping the amount that they want to finance, right? This is where they are trying to plug the gap till it is going to IPO stage. Okay. Now, financing formative stage. Now, formative stage basically where you are investing as an angel or pre-seed. Formative, the company has not yet done much, it just started. So you're putting pre-seed stage. Okay. After pre-seed, you put a seed. Okay. Now, this is nothing in the idea stage. That's called pre-seed. You not even put the seed, you just have an idea. Idea पे कौन invest करेगा? Obviously angels. We call angel investing. Once the idea takes shape, okay, you're doing some research, development, you're shaping the idea. That is called the seed stage. Okay, so you have pre-seed, then a seed, then you have the early stage where you start actually converting the research development into something that is more fruitful, right? Here you have startup financing where you're trying to complete the development and you want to start commercial production, correct? So this is called the early stages, okay? Where you are first startup, then your first stage, and you're starting commercial production. So pre-seed, seed, and then you start doing commercial production. After doing the early stage, obviously the later stage will be second stage and the third stage. Now, second stage is where you're trying to move forward, enhance your production, and then you're going to expand. Yeah. So these are basically the 5 stages of your growth, and each stage has a certain type of financing. Obviously, यहाँ पे कोई venture capitalist नहीं आएगा. He'll be like mostly he'll be your parents or close friends. They'll be the angel investors. Then seed capitalists were trying to continue a little bit of funding. Here, venture capitalists will come to help you complete production, to help you do commercial production, to help you enhance, to help you expand. This is where the venture capitalists will start coming. Normally, they may not even come here till they see some production, but here surely they'll start coming as they see more and more production. Remember, these 5 stages also differ in terms of risk. Here is very, very risky. Risky is there, lesser risk. Risk is much reduced, and here you are already doing well, so only expansion. So therefore, the risk is almost minimal. Here, this is how the stages go. Obviously, minority investing, I guess the development capital is where you are investing in development activities, right? Normally, PIPE is an example where you have private investment, right, in public equity. That's called PIPE. Okay, you're investing public equities through private. Distressed investment is obviously where you are doing investment in distressed companies, especially like bankruptcy, companies going bankrupt, you go to court, you buy the company in doldrums, and then you make it bigger. That's called distressed investment. This is also called as vulture, because it's like the company almost dead. It's gone. And vultures are eating up the company. You dive in, you buy the company out, and you try to revive the company. Correct? So that's called distressed investing, or also called as vulture investment. Clear with that? Then clear the option. So here, one thing you should remember is the IBC or NCLT, where you go to NCLT and you buy the company out through the IBC forum or NCLT forum. Clear? Okay. Now, obviously, if you invested in a private company, what are the exit routes? Right? Obviously, the main exit routes is IPO. You are invested only because you want to go into IPO stage, right? Apart from that, let's say the company's IPO is delayed. Okay, then it doesn't mean that you can never get the money back. You can probably go through and sell it to another person who is also maybe a venture capitalist or a tiger shark like you, and you can sell it to them. Or you can try to recapitalize it, use more funding, put more money in, pay yourself some dividends. You can try and do that. Okay. Other part of that trade sale के अलावा you also equity market sale. Instead of selling to another investor, you can probably say, boss, in my fund, I'll transfer my firm to another firm. You're doing like a secondary sale in the same market. Clear? Or you can obviously, if there is no further, it's not made much profits, or you feel there's bleeding money, then you might as well liquidate it and go close the transaction. It's better to pull the plug rather than bleed more and more money. Yeah? And that's called a write-off or liquidation stage. So these are the broad 5 stages for private equity investment. Yeah? In private equity, there are 3 broad forms of debt. The debt can be direct lending, mezzanine, you know the concept, which is bridge financing and venture debt. Now, direct lending is where you are getting borrowing directly from the banks, right? The private investors, they will provide capital borrowers, so borrowers are getting money directly in the form of loan, and you pay and you get interest, right? Here they'll pay basically the loan which is based on the collateral, okay? And they'll invest in these loans. Mezzanine debt is where basically a form of private credit where it is subordinated to senior secured debts, okay? Basically in the company, you have equity, right? You have debt, and then you have mezzanine is senior secured debt. This is the bridge, and that's what's called mezzanine funding, right? It makes a pool of the additional capital available beyond senior secured debt and typically uses them to finance LP. So this is the debt which is in between the existing debt and the existing equity. Venture debt is obviously a funding that comes in the form of venture capital, people issuing debt. So venture capitalists is saying, chalo to debt later, because obviously don't forget bank loan is very difficult to get for these people. So they'll go to venture capital and say, boss, you give me your debt, and that'll be called a venture capitalist debt. Here, the back is from the venture capitalist. Okay, so there are forms of debt, obviously, apart from the typical bank loan that you will probably borrow. Distressed debt, similar names, where it is company having a distress, any financial difficulties, they will go for a distressed debt and they try to pick it up in the market. Other private strategies based on that. Okay. You can also have collateralized loan obligations, CLOs, where you have loans which are backed by collaterals. Okay. You can have a portfolio of loans, you can have leverage structure vehicles, you can have SPVs, you can have SPEs, you can pick up loans through vehicles which are set up for the purpose of obtaining further loans. Okay. Now, some of the benefits of private equity is obviously the biggest benefit of private equity is it is diversifying your portfolio because it has a different set of risk and rewards, right? And obviously, they give you better returns. Private equity obviously gives a much higher return, but the risk also are very high, which becomes a disadvantage. Obviously, don't forget, you're also stuck up with that investment because they're not liquid. It's not like you bought a share of Reliance or Infosys and can sell it. Here you can't sell because there's no market. So kya karega? You'll have to go and search for another venture capitalist buyer who's probably interested in buying it. Yeah. So highly liquid, high risk, and obviously historical database of them. You may have data may not be available, so you may have survivorship bias and backfill bias. That's a bigger problem. Clear? This is private debt. Okay, private debt obviously the beginning of private debt gives you high yield opportunities. You can earn more than what other debt is giving. Okay, and they can realize the higher returns because remember it's illegal premium. But the bigger risk is obviously there is higher risk involved and there is a higher illiquidity. Remember, default risk is more possible because you privately given the borrowing, so it's a private debt. So these people don't have much collateral or much credit rating as well. So therefore, you run a greater risk with such people because they don't have much backing that will allow them to repay the amount. Clear? So that's the difference between private. So private equity, private debt, they have their own benefits. They have their own set of risk as well. Clear? Any questions, guys? Okay. So again, you know the norm. Take 2 to 3 minutes. Go through a question before you and try to mark the answers. Read carefully, guys. Right. So what are the answers? Okay. So which stage? So venture capital fund will normally invest at what stage? So remember, angel is never the stage because angel is too early, too premature. He'll never do pre-seed. Angel is always friends, family, parents. So not angel. Will he do in the startup or seed? Now startup is too late. Potentially he'll want to invest a little earlier so that he gets exposure to a higher return. Right? So normally try to put in seed capital. Seed capital help him to convert the idea into workable solutions, getting an approach. So seed, remember seed to startup is where they'll normally involve. But seed would be the first step. You can expect any venture capital fund to come in. Okay, but never angel because angel investing is always by angel investors. Clear? So the answer is seed, not pre-seed, but seed. Secondary sale. Whom do the companies sell to in a secondary sale? So remember, secondary sale is it's already there with you. You sell to someone else who's in the same market, and that someone else will be for a private fund. It will be another private capital fund. Correct? Unitranche. Uni means one. Correct? Unitranche debt means what? Single debt, one debt. So the answer is unitranche debt is where you combine different debts into one debt, and that's called unitranche debt. Clear? Number 4.
That's the bar.
What's the answer here for number 4? Which type of private fund is most likely to earn excess return if it's vintage? Vintage year means first year. When they do this is during economic contraction. So vintage are the earlier years. If the earlier years contraction, which fund would do really well? If it's a contraction period, everyone is doing bad. So in that period, the distress fund would be the best. In a contraction, you don't go for leverage because you end up paying high interest, high loans. Venture capital funds is more in the seed capital. Right? Distressed debt is where you are initially in a contraction period, that the distressed debt, when the distress is very high and you want to look at growing in the high period. Yeah. So the answer is distressed. Any questions? Read carefully. Learn the art of how to solve the answers. Sometimes you may not the answers, you may not know the answers, but you should know how to eliminate the wrong options. That becomes more critical at times. Clear? Yeah. Clear? That's your answer for you. Right. Okay, now let's move on to the next part, which is real estate and infrastructure. Obviously, real estate is all about investing in real estate buildings, offices, residential, commercial, both, and infrastructure is more of where you're investing in, let's say, metros and other projects and so on. Okay, same learnings, features, characteristics, that will make sure you learn those, and how will you understand the risk, rewards, the benefits. Okay, now obviously, real estate investments was a potential. Obviously, here there are two things. If you invest in real estate, you're going to earn rental income, obviously, and you're going to earn capital appreciation. That's the biggest benefit of real estate. You'll get a recurring income and you also get an appreciation income. Yeah. The limited cash flow impact, okay, less than perfect correlation, and obviously the potential hedge against inflation. Okay, so real estate is useful in that sense that you can actually, when you discuss the appreciation, there's actually a potential hedge against inflation. Why we say that? Because as the prices go up, the property value also will go up, the rental income also will go up. So you are also protected against the inflation in the economy, because this investment will give you a higher return if the inflation is high. So you're effectively protected against increase in the underlying price. Is that clear? Clear? Okay, that's a very important point when it comes to real estate. Okay, like I told you, return is always through rental income and capital gains. Very, very important. Both gives you return. Also, income tax, also rental income will give you, will tax, will tax your rental income essentially, right? As per income tax act, and capital gains will be a capital gains tax, whatever 12.5 or 20%. You will be diversified because the returns are different from traditional investments. Inflation is already discussed, right? It is not divisible. You can't invest in, let's say, say a hall. You have to invest in the entire property itself. Thank you. In the entire property, so it's not divisible. Therefore, the key feature of this is it's a large investment. So in Bombay exam, if you pay 2 or 2.5 crores to invest in a house or a land, right? The horizon long term normally transaction costs are very high, and obviously they're immovable, right? And they're very unique, correct? It can be illiquid. That's the biggest problem. And remember, real estate market may not be as efficient. It will not be inefficient because information will not be readily available. Here, these features are a little important, a little tricky. Please make sure you understand that quite well. Any question on that? Okay, this is real estate investment features. Now, what are the forms of real estate investments? Okay, the forms. Okay, you can have. Okay, now you can have private. Okay, private, public, equity, debt. Yeah. So there are 4 broad forms. Okay, where you can invest. Privately, you can do through debt and equity, or publicly through debt and equity. Right. Now be careful to understand carefully. If you invest in real estate, right? Now privately, if you're doing through debt, debt means a mortgage, right? The normal house loan which you take, construction lending or mezzanine department. Here you are basically privately investing in the mortgage, okay? Or you could take equity where you are actually taking ownership of the real estate. Ownership could be through sole ownership, joint venture, partnership, separate from whatever it is. You could either take direct ownership or you could do indirect ownership. Direct is by buying it, indirect is through a fund. Or you could also get a direct stake by investing in real estate investment trust. It's called REITs. Basically, these REITs are set up, they buy into real estate and you can buy a unit into the private REIT. This gives you equity ownership, either direct, indirect, or private REIT. Clear? So privately, if you want to invest in real estate equity, you can do direct, indirect, or REITs. Privately in debt through mortgage or funding. Now, public ones which are publicly listed. Okay, publicly listed, you can just go and you can buy it of the listed, and you get an exposure to real estate. How do you do that? Let's go to equity again. You can buy either in exchange rate funds, index funds, mutual funds, listed. All of this will are basically avenues which are dealing in real estate, and they're using your money to fund in real estate. So since they invest in real estate, you are getting exposure to real estate. Why they are in the public equity? Because these are things that are listed on the stock exchange. These are not listed. These are listed. But both of them give you a direct exposure to real estate. Here, best is exchange rate funds, very popular. You go buy and sell exchange rate funds of the market and you can get exposure. Public debt. Public debt is mortgage-backed security, CMOs, collateralized mortgage obligations, mortgage REITs, and exchange rate funds. These are all a part of public debt. Clear? Okay. So we have private debt and equity and public debt and equity. Now, real estate investments, you have two forms. One is residential property and you have commercial. Like I said, either you can invest into a property where it is for resident purposes, say housing, right, or for office purposes. Now again, if you're directly investing, right, let's say you went and bought a house. Obviously, in most cases, you won't just buy the house with full equity. You always go for a loan, right? So therefore, it is called leveraged because you always are ending up buying a house on an EMI, correct? Which is why it's a mortgage. Now, a lender could also pool the mortgages to buy. So let's say someone lent you, let's say a bank has lent money to 100 different lenders, 100 crores, 1 crore each lender. All of this mortgages can be pooled to form an RMBS. So a lender has probably given to 100 people 100 crores. This 100 people, he will form an RMBS pool. And this pool might be then sold to different investors. So this is what happened if you remember the subprime crisis. The lender pools the mortgages to form RMBS and you can invest in that. Okay. The lender should undertake. Now when a lender gives a loan, he should make sure that the borrower has made enough equity contribution. He should have made a down payment. That is very important, a down payment. He is able, because down payment is a good amount, that means the property market if it falls, it will still be above his borrowing, right? He should have good credit rating. There should be sufficient cash flows because remember, these cash flows will be paying to the investors and obviously the value of the home should be appropriate. There should be a proper insurance also. This is what the residential property market would look like. EMI, mortgage, you'll have a pool, you'll have funding through SPV. Now, commercial property on the side. What is a commercial property? Where office property, these will generate an income, right? So these are through office premises. You can have a direct investment as well. Okay. Normally, creditworthiness is more critical, but you're still here, and you'll have to analyze the property valuation. Okay. Here also, like RMBS, you'll have a CMBS. Why? Because commercial property. So all of the mortgages that are backed, he'll make a pool and then be sold as a CMBS. Here, take a minute to read that carefully. These are the two important features of real estate investments, both residential and commercial. Now, what's a real estate investment trust? It's called a REIT. Now, real estate investment trust, basically, they will issue shares. Okay, these are trusts that are invest in real estate, and against the investment, they'll issue a share. Those shares will be publicly traded. So they issue shares to everyone, and those are publicly traded and listed on the stock exchange. So if you want to buy a share of a REIT, you can go and buy it from the stock exchange. That'll give you an exposure to the real estate that the REIT already purchased. Example, the REIT would have purchased, let's say, a building for $100 million. Let's say Barclays Bank in this London for $100 million. So that building belongs to REIT of 100 million and they will issue shares against that. So when you buy a share in a REIT, you will own a certain part of the building as well. But here you own a part of the building through the REIT. Clear? The REITs investments obviously will form equity or debt, and that REIT will probably earn income or earn appreciation, and that income appreciation will pass on to you as an investor in the REIT. Okay. Now different types of REITs are can be there based on the real estate, hotels, malls, offices. These REITs can also invest in, let's say you have Infinity Mall. That Infinity Mall might be worth 50 crores, whatever I mean the value. That is invested by a REIT, REIT. And if you can buy, let's say you can buy 1 lakh, 5 lakhs of investment, whatever income it makes from the Infinity Mall, that income will come to REIT and that income will come to you towards your share in the REIT. Okay? So don't think all these malls and all are made by onto investors. They're normally funded by REITs. And the REITs will keep earning rental income and appreciation. Okay. Now the REIT has the obligation to distribute all the income that they're earning to you as dividends or interest income, right? Because you are a part of the stake. So they'll try to make sure that after applying the requirements, they will provide you all your dividends, right? They also provide tax exemptions, obviously. And occupancy rates and rent amounts are the key earnings drivers. Example, if you have a REIT in a hotel, let's say marriage hotel, right? They are invested in that. Obviously, the more the occupancy, the higher the income and the higher the returns. So occupancy rates and the rent amounts, malls, offices. Sometimes you have a full mall and you have several open places. People should take up the place in a mall, right? If the occupancy is also limited, then you may not earn as much as you should be earning for the mall. So this is a big driver for income from that hotel, mall, or office. Yeah, this is how essentially a REIT will work. Okay. Now, mortgage-backed securities, we saw in the earlier slide, MBS, I call it, where these are the mortgages that are backed, right? Based on the backing of mortgages, securities are issued. So here, if let's say I have 100 EMIs, 100 homes, right? Now 100 EMIs are backed by 100 houses. So these houses are mortgage backed. Against these mortgages, I will issue securities. And these securities are issued to investors. Now these securities are backed. They are backed by these mortgages and they issued to the investors. This is called mortgage-backed securities. The investors are glad because they have the backing of the fiscal house. And this security will earn EMI from them and pay it to the investors. Got it? The securities will transfer the earnings to the investor because the investors have purchased. They have purchased units in these securities, and this security has given a loan to these people. Here, this is how the mortgage-backed securities works. Based on the pool of mortgages, the securities are issued to the investors. Here, and like I said, if these mortgages are residential or they could be commercial. If they are residential, then I'll probably issue RMBS. If they're commercial, then I'll probably issue CMB. Here, any questions? Now these RMBS, CMBS could be issued either privately or publicly. Right? So this is that investment where you can get a stake in a part of residential or commercial by simply buying one unit of security which is issued by them to the public. Okay. And the returns you'll get will be the EMI that is being paid to recipients. Now, if you look at private fund, okay, now what is private fund investing type? Where you're investing privately or to the public or listed share, right? Real estate private equity funds, they are basically infinite life and they're open-ended. Open-ended means people can come and invest whenever they want. Okay, there is no, see, closed-ended is where I stop and I don't allow people to enter. Open is where I say people can come and invest whenever they want and they can leave also when they want. So real estate practically fund means a real estate based equity fund, fund which is private equity, not public equity. These funds will allow people to come and go, but privately, not through listed, not through the stock exchange. And the life is infinite because there's real estate. Okay. Now, open-ended funds obviously they'll give you exposure to core real estate, right? And they allow you to invest and get exposure to the real estate. Core plus strategies, core plus, they'll accept slightly higher risk derived from non-core markets and sectors with slightly more leasing risk. Okay. So core plus is where they're trying to get a higher risk and a higher return. Okay. If it's finite life, now this is infinite. Finite life, that means they are close-ended. Okay. These will be where they're trying to generate value, opportunity, but this is where the fund is only for 3 year or 5 year period, right? So you're trying to look at a fund over a period of life which is finite, and they're trying to generate return in alpha, beta, generating value add and opportunistic investment. So they try to alpha opportunities, build it up, and then sell it off. Okay. So these are finite life. So you have both infinite life, open-ended, and finite life, close-ended. Clear? Now, what is value add? Value add is where they're trying to create value to the investments, right? Maybe they'll do a redevelopment or an upgrade. Let's example, let's say a building is going to undergo redevelopment. This fund will go, they'll probably say, okay, fine, we'll take over the building. Okay, we'll pay 25 crores, we'll take the building over, we'll redevelop it, we'll invest 25 crores more, we'll make a new building and we'll sell to new people and we'll make 100 crores. So they made a profit of 50 crores, right? By going to a development or redevelopment or upgrading the building, and they're investing, they're buying it, upgrading it, and they're selling it. They added value, right? So value add investment where they purchase something, add value to it, and then they sell it. Okay. Obviously, the value they add should be more than the amount of cost they incur to add value. Opportunistic investing means you're looking for the right opportunities. You're looking for opportunities to get to invest into something. It accepts a much higher risk of development. Okay, like major development, repurposing, and so on of assets, taking on large vacancies and speculating on significant improvements in the market value. So you're trying to look for opportunities that are existing or probably that are there, and you're trying to search for more opportunities. You're trying to sense like where I might get a higher value. You're trying to get probably opportunities that are there but not yet tapped. Maybe vacancies, maybe there are improvements in the condition that may happen. You're trying to sell those opportunities and then invest. Obviously, it is much higher risk. Here, so the opportunity invest. So there are various types of investing styles by the private funds. Here, obviously, the most common one is value added because they like, I don't know if you're aware of this program called, whereas in UK they have a program, in India also, where these people they'll buy broken down homes and distressed homes. They'll spend 6 months to convert into a brand new home and they'll sell it for almost double the market price, right? So they're selling distressed properties or poor properties that need redevelopment. They'll develop it and they'll sell it for a much higher price. Yeah. So this is called value add investments, most popular form for private equity investment. Now, what's the performance measure? Means how do you measure the performance for these real estates? Okay. Now, remember these are not easy to be measured because they are private. They're not publicly listed, right? So how do I get a performance? So there are various ways. There are some indexes. One is appraisal based index, where the index is based on appraisals to estimate the value, okay, of that property or real estate. Okay. Now, how do you get that value? How will you find out the value of that certain property? You can't know, you won't know the value of a house, right? If I say, well, the value is 2 BHK, how will you find the real value, right? Now, the best way is to find out the value of another 2 BHK that are sold in a similar area in the same time. You can't take or 2 BHK sold 2 years back, or a 2 BHK sold, let's say Andheri, but I say in Borivali. You have to compare. You have to look at comparable sales that happened of that real estate in the same period, right? Or you can look at maybe what's the cash flow. How much cash flow will I get from renting the 2 BHK over the next 20 years? That would be my value, right? Comparable sales, comparable cash flow, and so on. But obviously, remember, recent transaction is not important. ये नहीं कि boss वो area में 2 BHK should have been sold only then. No, that's not always important. You will get many benchmarks. What is the comparable sales? What is the value of a similar, let's say 3 BHK? Reduce by 1 BHK, make it 2 BHK. Find the comparable sales. Try to look at future cash flows. Okay. You have to also make sure that you're smooth your return. You can't find out spikes. Achha. Random sales should not be taken care of. You should take out general sales. Okay. Don't look at standard deviation, obviously, because normally understated. You have to ensure you look at the normal sales in the normal conditions. So this is appraisal based index. We try to look at the value based on recent comparable sales in the same area, same period, same time, similar value. It should be completely comparable. Okay. Repeat sales index. Now, repeat sales index means where I'm trying to look at the repeat sales of the same property. वही property का जो repeat sales हुआ, how much it must have taken care of. So that's called my repeat sales index. Okay. Higher the number of sales, the better reliability. If there are more number of sales that were repeated at the same time, I can rely more on that. Okay. So higher the number of sales, you want to look at the repeat purposes. Now this also captures the market conditions over 2 periods of sale. Okay. So I'm trying to see how many are being repeated and based on your capture market. Possibility is there that transacted property are the ones with significant changes in the value. Okay. But it may not be the true representative because remember, if you're seeing repeat sales, which repeat are you looking at? Okay. Transacted properties are the ones with significant change in the value. You have to try to look at those which have a similar value and were transacted around the same time. Okay. So repeat sales means if that property was sold multiple times in the last 5 years, more repeat number will give you a better representative value. Here, the reliability is greater if you can see more repeat orders. Obviously, it may not be so reliable in India and Bombay, but more UK, US is more reliable because there are people in office keep on buying and selling, right? Rate index. Now, rate index, you already know what a rate is, real estate investment trust. Trust here, you're looking at the market price of all the REIT shares in the market. And they're getting a REIT index and they're trying to find out what is the shares, what is share price of this REIT. Okay. So here you're trying to get common index of all the REITs and take a total value of that. Okay. Obviously, similar to equity indices, like you have banking index, you have the Nifty, the Bank Nifty, you have the Nasdaq, you have the New York Stock Exchange, right? All these are indices. Similarly, you have the REIT index, just like the Nifty 50 index, right? You also have something called a REIT index. This Nifty is the top 50 shares. This is the top REIT shares which are in the market. Clear? So similar to that, it's completely identical. Here you have to know which index, what's the construction to actually know how to track the performance. Yeah. So these are the various ways of measuring the performance of the real estate market and the investment. Here, appraisal based, repeat sales, and the REIT index. Any questions? Now we've looked at returns. Obviously, now we look at risk. What are the risks in the real estate investment market? What are the main risks? Obviously, the biggest risk is the conditions. Remember, real estate could be, let's say you invest in USA, in London, in India, in Australia. You have to look at what are the local risk and the global risk, right? There could be changes in the government. Let's say in India, when Congress was there, BJP came to power. In the US, you have the Labour, the Democratic. You have to ensure that any change in government and political parties would impact the government rules and regulation, and that would also impact your investment risk, right? You have to ensure the properties are being managed better, right? Expenses, you have to have a real estate agent. Obviously, you have to make sure you get the right amount of return, right? If you're investing in distressed property, please ensure you understand it very high risky. Ensure that you develop it well and you sell it in time. Okay. Leverage is very high normally. Leverage will be very high. The amount of borrowings that come into. Okay. And the biggest concern is liquidity. When you invest in real estate, remember it's not like 1 lakh, 2 lakhs, or 10 lakhs. It's all about liquidity. That is the biggest concern in real estate. And that liquidity could always have an issue. So please look out for that. That illiquidity could be a big risk in the real estate investment market. Clear? Okay. So we learned about what are the risks, what are the returns on the real estate. Okay. So please learn and understand how to identify, how to measure risk, what are various risks, how to measure returns, what are various indices, performance, so on. Okay. Now let's go on to the next part of this which is infrastructure. So we discussed real estate. Now let's look at infrastructure. Now infrastructure is what? Similar to real estate, but it's more about where, example, you're building the Atal Setu bridge, the Worli ceiling. This is all infrastructure, right? You have the metro project. That's all infrastructure projects. So infrastructure assets are basically where you are investing in the infrastructure development that the government is undertaking. Because remember, the government will not fund the entire money from their own pocket. They'll probably borrow money from the people. They'll probably take equity from the people and say, boss, whatever money I make from this, let's say I make the Worli ceiling. The Worli ceiling revenue will be something that's paid to the people who invested in that infrastructure. Here, makes sense? So, why do we invest? Because obviously, see, let's say we made the Worli ceiling. It must have taken 5 years to make it, right? It is a capital intensive project. They paid around 1,500 or 2,000 crores they invested to make the Worli ceiling. Obviously, they'll generate revenue out of that through tolls, right? That revenue is the return that you'll get for the investment. It's capital intensive. It is a long life. It takes also long to build it up. So the asset is very long lived, correct? And remember, this asset is for public use, right? Around the Worli ceiling is for public use. The metro is for public use. So these are for public use. They cater to essential services. Who funds them? The government normally finances and funds them, right? So like your public-private partnership. But the government is not spend the money on its own. They might form a private or public partnership with the other people, right? So what will the categories be? They will lease the assets back to government, or they sell it to government, or they hold and operate the assets, right? So when a person takes an investment in infrastructure, they say, fine, I'll buy it and I'll lease it to you, or I will buy it from you and I'll sell it back to you, or I'll buy it and operate it on behalf of the government, like the ceiling, the tolls, right? They're normally operated not by the government, they're operated by the operators. They will collect the toll and they'll pass on the money to government, right? So they will hold it and they'll operate these infrastructure assets on behalf of the government, right? So even the ceiling, when they prepare, the operator will make the entire ceiling on behalf of the government. They'll operate the tolls and they'll recover the money from the toll, right? That's how they recover the income and they pay some money to government. Clear? Now, why is it a problem to invest in infrastructure? Because the amount of investment is huge. You can't just go and, let's say a ceiling is 2,000 crores, right? It's a huge investment. If you want to invest, you will have to probably pay 10 crores, 50 crores. The amount is not small, not big. So there is a barrier to entry, right? You and I can't invest. These are big investments which will require a large amount of capital. Obviously, the returns are always in the form of regular cash flows and appreciation, right? Because you will be earning income from regular income. Like metro, if you invest in the metro project, you'll be earning income from the regular income that the metro is earning from selling tickets to the people, right? Okay. And obviously the intensity of infrastructure investments will depend on the demand and supply, right or wrong? Now the metro project took a long time. Finally, the demand is high. People are liking metro projects. So the demand might increase. Interest by the investor also might increase. Supply will increase as the government desires to do more and more. So as the government is doing more projects, the supply of such projects will also increase, right? So infrastructure in a nutshell is all the investments that you're making in the infrastructure of the country, like highways, roads, metro projects, toll nakas, and so on. Are we clear? I hope you all guys understand what it means now. And I don't think you really understood before this about how we can actually invest in the infrastructure assets of the country. Clear? You can do it through such investments. Okay. But don't forget, the investment is high, appreciation definitely is much higher, the income is quite regular, and this is what the government also guarantee, right? Now the infrastructure investment categories, broadly, it could be many types. Okay, you could have economic assets, where you can economic activities, social infrastructure, which is towards social causes like healthcare, educational. You can have hospitals being put up. Those are all social infrastructure assets, right? They could also be based. This is based on the type of infrastructure. This is based on the stage. You have, please learn the words carefully. Brownfield and greenfield. Brownfield is where the infrastructure is already existing, right? Brown is already existing, and the government is looking to privatize it. It's going to take it over. Greenfield is where it is not existing, it is to be created. Okay, so brownfield is there, greenfield is not there, to be created. Obviously, if it's existing, the risk is low. If it's not existing, then the risk is high. Please understand. If you're newly constructing, then it will be a high risk. Are we clear? So clear brownfield and greenfield, please learn this carefully. Existing, not existing, low risk, high risk. Correct? Risk controls are also depend on category, stage, term, and geographical location. Obviously, when you invest in infrastructure, you only have to look at where you're doing it. Let's say Bihar or UP or Delhi, Gurgaon, Bangalore. Which location? Was the state? Are you investing in the initial stage, later stages? Okay. What's the form of investment? What's the type of, are you investing in a mall, in a product, in a highway, or in a hotel? What are you really investing in? Not in hotel. Roadways, railways, metro. What type of investment are you looking at? Clear? So when you invest, it's important to understand what's the nature, type, and the exposure that you're going to get. Clear? Again, the forms very much and what you learned in real estate. Here you have direct form and indirect form. A direct form is where you are directly purchasing the asset. That's normally not possible for infrastructure because you need a large investment. Liquidity risk is very high. Obviously, the only people who can do it are the people who are managing and operating assets, like the toll operator. He's purchased it and he's operating the toll, let's say Wally ceiling, and the revenue belongs to him. So that's a direct. Indirect is where you're buying the exposure in the infrastructure. You're probably purchasing either through an ETF or a listed fund. A fund is already invested in that and you purchase units in the fund, or maybe through a private equity fund. Okay. Obviously, this is a little better because you have better liquidity. The fees are reasonable and you don't have to really manage. You can just sit and wait and earn your income on a regular basis. If you feel you want to sell it, you can also sell it through the market. These are listed. Probably there are other people who can buy it. And the best part is you don't have to put too much money as a minimum. So this is like as if you're to say hedge fund here and you're to say mutual fund here. Here it's all about you don't have to manage much. You are getting the regular income. Fees are reasonable. Minimum amount is low. Here you're a little bit involved. You're getting a higher exposure. You're directly controlling it, and here you have to invest a higher amount. Here, liquidity is better here. Here there is higher liquidity risk. Here, because that's more illiquid. Right? Quickly, what is the biggest benefit of investing in infrastructure? Now remember, in infrastructure, you're getting cash flows. Right? You're earning from the toll receipts, you're getting dividend payout. Obviously, the biggest benefit of this is you're earning regular income. So apart from the appreciation, like real estate, you're also earning regular income and regular cash flows, right? But what is the risk here? Leverage is high. And obviously, it depends on what type of projects are you looking at. If it's brownfield, obviously, the risk is normally low, but the operation risk is high because it's already existing, so to operate it. In a greenfield, the risk is high because the construction risk is there. It's not constructed, so it might take time to construct. There's a huge construction risk. Clear? In this, regulatory risk is also quite high because you're looking at infrastructure, and obviously the biggest risk is political risk, currency risk. If you're investing in infrastructure for US, you never know, the currency might go up or down, political party might come and change, so all that might impact your overall risk out there. Clear? Okay, so you are getting cash flows, no doubt, but you're also exposed to many risk, country risk, political risk, regulatory risk, forex risk, operational risk, construction risk. That is all going to be there as well, right? So they have their own share of risk and rewards when you look at infrastructure investment. Any questions? So let's quickly get a few questions, guys, to conclude on those. Okay. Now again, read the questions. Take some time to understand what's the answers here. Take 3 minutes to solve the 3 questions. Yeah. Please read it carefully and know what your responsibility is. Just a minute. Right. So what's your answer, guys? Please near a bit more. Complete the answers carefully. Right. So what's the answer, guys? First one. Which of following is most likely an advantage of deal? Now read the word most likely. Most likely means, now remember, both could be an advantage, but I want to know which one is more likely an advantage, or rather most likely. Okay. Now direct real estate which is direct. Remember REIT. REIT is indirect, right? So directly investing real estate and indirectly, which is better? REIT is listed, right? So REIT has a higher liquidity. Correct? And REIT has a higher diversification. But when you directly purchase real estate, you have a better control. So they ask me advantage for real estate. So this is the advantage for REIT. This is another REIT, but this is advantage for real estate because you are purchasing the estate directly and you can better control because it belongs to you. In a REIT, you can't control the underlying real estate because you purchase the units of a trust which has purchased the real estate. So real estate, REIT has a control of the underlying estate, but when you directly purchase it, you have a control. So the correct answer is C. Are we clear, guys? Please learn how to attend the question. That's very important. You learn how to get the right answer. Which of following is best categorized as a direct investment in infrastructure? Now, infrastructure, and I want direct investment, right? Not through a rate or something. So what's the answer? Infrastructure, exchange traded fund, ETF. It is listed, so it is indirect. It is infrastructure, but it is indirect. So wrong answer. Master limited partnership. Master, it looks like there, but is there any infrastructure word out here? Is it an infrastructure? Not at all. First mortgage toll road. Toll means infrastructure. First mortgage. You took the first mortgage. Matlab, you took the loan. The loan is a mortgage that you have occupied. Direct and infrastructure. So the answer is C. Clear? Please learn how to attend the questions. You should know how to eliminate. Very important. Okay. Which of following infrastructure projects is most likely to offer the highest expected return? Most likely. Okay. Now remember, return is always linked to risk. So when I look at return, remember, if you don't know the answer, look for risk. Wherever the risk is higher, the return is higher. Because the word is expected. So obviously, you are not a fool to expect a less return on high risk or vice versa, right? So expected return will always be equated with the risk. The greater the risk, the greater the expected return, right? And vice versa. Lower the risk, lower the expected return. So you need to find out which of this has a higher risk and therefore a higher expected return, right? Quickly. First lien mortgage means a first-hand mortgage on an existing toll road. Existing toll road is brownfield or greenfield? Brownfield. Brownfield means risk come here. So return will come later. Toll road already existing. First you got a first lien mortgage also. So this is direct real estate which you can control better and it's existing. So this is not so risky. Okay, okay, it's risky or not so risky. Equity investment, again direct investment, which is good in a new airport, right? Brown or green? It's a brown field because the airport is already existing as a development country, right? Or maybe it's also being, let's say brown or green, but it's a developed country. So maybe it's a brown or green, depends. If it's a new airport that is being constructed or it's a new airport already constructed, but it's a developed country. So developed country means risk thoda kam hai. But same investment in new passenger airline, abhi airport airline mein risk is same, but here it's a developing country. So where's the risk higher? If the country is already developed, like USA, UK, the risk is lower. If the developing country, let's say, invest in maybe a developing country like maybe India to extent, or a smaller country which is still developing, then the risk is obviously going to be much higher. And if the risk is higher, you're going to expect a higher expected income. Here, right or wrong? So remember to find out where is the risk likely to be greater, and therefore where is the return that's expected likely to be higher. So the answer is C. Here, because it's a developing country. There's also, so you can say a brown or maybe the green field also if it's a new that is to be constructed or new already constructed. But my concern is what's the country only. Obviously, brownfield is less risky, greenfield is more risky. So maybe this is a greenfield because new to be constructed. Even then, the risk is higher in a developing country. Clear? Obviously, I'm not saying it's less risky, but the answer is most likely to offer the highest expected return. And I'm also not saying that you'll get a higher return. The expectation of return is higher in this situation because the risk is higher. Are we clear logic, guys? Please learn to interpret the questions between the lines. You have to try to learn the question carefully, read between the lines, and then answer. Here we get the answer. So it looks like all the answers are C, C, and C here. Here? Okay. Let me look at a solution. Yeah. There you go. And guys, whenever you solve the answers, please try to read. Maybe you got the answer right by Matka, maybe you guessed it right, but the logic was wrong. So please try to read what is the solution and what is their answer. So like see, direct debit debt investment. So direct is always better control and therefore it is direct. Other two are indirect. So you have to try to eliminate which is direct. If there are two indirect and one direct, then choose the direct option because it can't be there are two right answers. Here they mentioned greenfield. See, I mentioned greenfield or brownfield, but here they say it's greenfield. It could be a brownfield also, but depends on the interpretation. Greenfield, but they're saying developing countries are risky. And when it's risky, they will give a higher attractive returns. Here, brownfield, the first option of brownfield, because existing, and therefore. So please learn the other options also. They could ask you a different question. Existing here, so it's a brownfield or greenfield. Brownfield, greenfield are often questions asked in the context of the meaning. Okay, so pick up based on that also. Please read the solutions better. Even though you got right or wrong, don't just say, okay, I got right, so I'm correct. Read the solutions also carefully. Clear? And make sure you read it well. Okay, fantastic. So on that note, we have covered the first part of alternative investments, where we discuss all those aspects of risk, returns, features, characteristics, brownfield, greenfield. We learned about equity, infrastructure, the various private debt, equity. Please learn them carefully. It's not as easy as seen, but these are non-traditional investments. So this is a part of your curriculum, almost 6%. Normally, you should get full marks in this topic because there's nothing much in terms of content is very limited. Okay, it's only I think one full entire 50 to 60 pages, but you're getting full 6 marks. Please make sure you don't miss that out. Okay, from the module. If you want to read a little bit more, you can read the instrument materials also. And please solve the questions from the back of the book. Okay? Okay? So good. So on that note, guys, we wrap up today's topic. Tomorrow we'll continue the second part of it and we'll finish off artificial investments completely. Okay? So tomorrow, guys, we meet up at the regular time. So yeah, we're on time, 7 p.m. We should wrap up. Great, guys. So we'll meet you guys tomorrow to complete the second part of alternative investments.